Hello everyone. Let's start with today's class. Before starting with today's class, let us do a recap of whatever market ratios we have done, or even other ratios. Because now we're going to go to the most important ratios, which are the EPS, earnings per share, and diluted earnings per share. So, as a recap, what is a PE ratio? How is it computed? Market price per share divided by earnings per share. Okay, what is earnings yield? Earnings yield, I told you, yield means always market price in the denominator.
Okay.
I told you that first, okay?
EPS by MPS.
Yes, EPS. It's a reverse of PE ratio, earnings yield. Okay, right. Next, how do you calculate sustainable growth rate? One minus, not dividend ratio, it's called something.
Dividend payout ratio.
Yes, dividend payout ratio into return on common equity. Okay, this is the sustainable growth rate. Okay. What is the other word for this? One minus dividend payout? Yes, this is the retention ratio. What they will retain in the company. Okay, retention ratio into ROCE. In other words, retention ratio into ROCE is the sustainable growth rate. Okay, now how do we calculate the dividend payout? How do we calculate the dividend payout? Akhila?
Sir, DPS by EPS.
Correct. How much of the earnings are you paying out as dividend? That's what it is. Okay? Right. So these are the market ratios we studied. Now, how do you calculate book value per share, common equity? Okay, out of that, if there is any preference dividend, you minus the preference dividend. Okay, divided by number of shares. Okay. Now, otherwise, you have to say equity minus preference equity. Okay, minus preference dividend minus even equity dividend. These are all reducing the equity, you know that? Okay, so even here also minus equity dividend if they have declared, okay, if they have declared preference dividend, if it's cumulative preference dividend, if they have declared or not, you have to minus it. Okay, divide this by number of shares outstanding. Okay, so this has been the recap of whatever we've done. There's one more ratio, market to book ratio. See, most of the cases, it tells you how to calculate. Market to book ratio. How is it calculated? See, the ratio itself tells you how to calculate it. Market to book. MPS, market price per share, divided by book value per share.
Okay.
I've given you a lecture on this, right? Why do we use this ratio? It's used even for valuation purposes. Okay. See, everything gives you how to calculate it, except the sustainable growth rate. That doesn't tell you how to calculate. Okay, that is a retention ratio into ROC. Otherwise, price earnings, price in the numerator, earnings in the denominator. Earnings yield, I have told you, yield is always market price in the denominator. Okay, so market price and then earnings on the numerator. Most of the ratios are telling you how to calculate it. Okay. Okay, now, how do we calculate dividend yield? How do we calculate dividend yield?
DPS upon MPS.
DPS upon
MPS, market price.
market price, yes. Because yield, I told you, always is market price in the denominator. Dividend is dividend per share in the numerator. Okay? All clear? All the ratios are good. Right. Now, the most important ratio is earnings per share. Pay very good attention to this because this is tested quite often. Okay? This is tested quite often. The shortened form is EPS. Otherwise, it's called earnings per share. Like the name suggests, it is the earnings, whatever they have earned for the year, divided by the weighted average number of shares. So basically, it's net income. This net income belongs to the common shareholders. The EPS is calculated per common share. Okay? It's not including preference shares. It's all based on common shares. Net income minus preference dividend, if any, divided by, now listen carefully, weighted average number of common shares outstanding. Okay, weighted average. I will show you how to calculate this. Average number of common, always common shares, not preference shares. Okay, common. S stands for shares outstanding. Okay, that's with the public. That is outstanding. That means it doesn't include preference shares. Okay. This is how we have to calculate earnings per share. Why is it so important? Because based on the earnings per share, the price, the stock price increases or decreases. Generally, a strong stock market which recognizes the value of shares would look at the earnings per share and price it accordingly. Okay. So earnings per share is very important. We'll come to diluted earnings per share later on. So first we will understand the calculation of earnings per share. Now let us say in January and December, we're taking the full year into consideration. You had 100 shares in January and the same 100 shares was there in December as well. Okay. And the net income was 1,000. No preference dividend, nothing. Okay. What is the earnings per share? Anybody? What is the earnings per share? You had net income 1,000. You had full 100 shares from the beginning to the end. Yeah. Anybody?
10, sir.
10.
Yes, 10. Because it is 1,000 divided by 100 shares, which is equal to $10. All good. Okay. Now let us look at a situation. I'll not put too many figures. I'll erase this. Okay. Jan to December again. In Jan, we started with 100 shares. Okay. We started with 100 shares. And the net income at the end of the year was 1,000, as usual. On 1st of July, they issued another 100 shares. 100 shares. Okay. The end of December, they had 200 shares totally. Fine. But how much is the EPS now? Can you calculate? The total numbers of shares as of end of December will be 200. But how much will you calculate the EPS? Don't do 1,000 by 200 because totally there are 200 shares. If you do that, how much will you get? You will get 5, right? This is not it because this shares was not available throughout. So you take this was available throughout. Okay, so you will take 100 And then as of 1st of July, it was 100 into 6 divided by 12 because it was outstanding for 6 out of 12 months. They use these shares for 6 out of 12 months. So that is 50. Am I right? Yeah.
Yes, you're right, sir.
So 150. So the EPS is not calculated on total shares. The book value is calculated on total shares. EPS is the average shares held in a year. Okay, what was held in a year, the average. Just like your bank, in your bank, they give you interest on the average bank balance. Not if you put 1 crore rupees on 31st of March, they're not going to give you interest for that full 1 crore rupees. Okay, the average balance. So this 1000 divided by 150, the weighted average balance of shares. So that gives you how much? How much is this? Anybody?
6.67.
6.67. See, it's not as diluted as $5. It has more strength. Okay. Because you didn't use, we take into consideration that we did not use the shares for the full period. Had you used it for the full period, it would have been $5 per share. Okay. Got it? Right. Now, another situation. Jan to December. Okay. You started off with 100 shares. On 1st of July, they issued another 100 shares. On 31st of August, they purchased, let us say 50 shares. They purchased back. This is now treasury stock. Okay, treasury stock. They purchased back. Okay, and at the end of the period, net income, they have still that 1000. How much is the weighted average? I mean, how much is the EPS? How much is the EPS? The January 100 shares they have. That will be there for the throughout the period. The July 1st of July, is outstanding for 6 out of 12 months. Am I right? July, August, September, October, November, December. 6 out of 12 months. So 50, as we did before. So you have 150. And on 31st of August, this 50 shares was not outstanding for how many months?
4 months, sir.
September, October, November, December. 4 months. That is 4 out of 12 months. It was not outstanding. Okay, so 50 into 4 divided by 12. 16.67. Okay, let us take 16.67. You have to deduct. You have to deduct. Okay. And then you're going to have how much?
133.34.
133.34. Let us put it as 34 or 33. We'll put it as 33. Okay. So the EPS is now how much? Can anybody tell me?
7.5.
Yes. Yes. 133.33. So if you notice, last time it was 6.67. Now it is 7.5. The treasury stock purchase has the tendency to increase the EPS, even though it might be temporarily. Okay. It has the tendency to increase the EPS because the number of outstanding shares is that much lesser. Okay, now guys, I want to just show you this calculation, what we have done. This 133.33, just write it down somewhere. Okay. Or you can write it down somewhere because I'm going to erase this. I'll just show you how this average is calculated. I'll just prove it to you. It is nothing but the average. Okay, by the long method. So I'll remove this, all this working, and show it to you in a long method. Suppose you have full, okay, like January to December. Jan, Feb, March, April, May, June, July, August, September, October, November, December. So if you had 100 shares in January, you would have 100 shares in February also, March also, April also you will have 100 shares, May also you will have 100 shares, June also you will have 100 shares. In July, how many shares will you have? As per this. Okay. In July, another 100 shares is added, is it not? So
200.
so you'll start having 200. Okay. You will have 200 in August also, because of the full month you'll have 200. But in September onwards, because on 31st of August, you're buying back 50 shares, is it not? So from September onwards, you are going to have how many shares?
150.
Yes, you will have 150 shares. 150, 150, 150, 150 until the December. Now, what I want you to do is take the average of all these, add it all up and divide it by 12. That's how you take the average, is it not? Just do that, please, and tell me what you get. First, add all of it. You can even multiply. Multiplication is nothing but addition. 1, 2, 3, 4, 5, 6. So 100 into 6. Use memory keys. Put in memory plus. 200 into 2. Put in memory plus. 150 into 4. Put in memory plus and recall memory. How much is the total? How much is the
1600.
1600 is the total. Is everybody doing it? I want everybody to work out even these simple things like addition and multiplication. Don't think it's below you. Okay, think, oh, it's only addition. No, let somebody else do it. No, you do it, you will make a mistake. That's the beauty of it. Okay, don't take anything for granted. Even in work, you notice how many mistakes we make, even addition. So to get things correct, you have to keep on doing it. Then only, even if it's the simplest task, only then you'll be error-free. Otherwise, you'll go on making errors. Okay. Divide this by 12. How much do you get?
133.
133.33.
The same thing what we got here, is it not? So what I showed you, what is called the weighted average method of calculating it, that is nothing but the simple average. Okay. What did we do? We took January as 100, correct? Then July, what we took as 100 into 6 out of 12. That means for 6 months, there is going to be 6 months out of 12 months. So you're multiplying it by 6. That means you're like adding 100 into 6 and taking the average there immediately, 12. Okay. And then we are minusing 50 for 4 months out of 12. Okay, that's what we are doing here also. We are taking the average immediately when we do into 4 divided by 12. So nothing but the simple average. These are the weights. 6 divided by 12, 4 divided by 12 are the weights. But ultimately, it's the simple average. Is that clear to you? Is that clear to you? So when we do 100 into 6 by 12, we are just taking that, we are multiplying by 6 because it's outstanding for 6 months, and dividing by 12, we're taking the average then and there. Okay? That's how I wanted to prove it to you that this calculation, what we did earlier, is the same as taking the simple average of all the shares outstanding throughout the year, like this. Total is 1,600 divided by 12, 133.33. Is that clear to you? Anybody? Everybody? So you know stock split. What is a stock split? I don't think you all know stock split, right? Some people may not be knowing stock split. All this while we have been doing activity ratios, market ratios, but we have not come across stock split. We did current ratios, liquidity ratios, solvency ratios. We have come across treasury stock, but we have not come across stock split. What is it? Anybody? Anybody has an idea? Suppose, let us say there are 1,000 shares. At par, $10. So how much is the equity, total equity you'll have? I mean, total number of common stock. I mean, total amount of common stock is how much?
10,000, sir.
10,000. Yes. A stock split, a 2-for-1 stock split. 2-for-1 stock split. What does this mean? For every one, you're going to get 2. Okay, 2-for-1, what you own. 2-for-1 stock split. For every one that you own, that you're going to get 2. Okay. So what will happen? This 1,000 into 2, it will become 2,000 shares. So if you have 100 shares, it will become 200 shares. Okay. So for every one, 2 will be there. But this par will reduce divided by 2. You understood? Because you're splitting it, you're just splitting the value also. Okay. So that becomes $5. And what is the total? Total amount of equity? Total amount of common stock?
Remains same, sir.
10,000, sir.
Yes, sir. It will remain exactly the same. Nothing changes. Okay, nothing changes. It's going to be the same. The dollar amounts don't change except the par value. Remember that. In a stock split, dollar amounts never change except the par value. Okay? Got it. So this is a stock split. It doesn't add any value to the company because there's no money coming in. It's just like this. You know, it gives a psychological effect that you have more number of shares, but it doesn't. You have a sandwich. Okay, if you have a sandwich, and then what happens? If you cut it into 2, like this, can we say that you have 2 sandwiches now? Can you say you have 2 sandwiches? You don't. You have the same sandwich. It's just split into 2. Okay, it's just split into 2. So if you have 1 share, it is just cut into 2 like this with value. Okay, so there's no addition of anything. There is no addition of amount. Fine. So in case of EPS, it has the effect of reducing the EPS because number of shares has increased. But you do not take the average for this because nothing has been added. Okay, I'll come to that later. Now let us talk about stock dividend. What is a stock dividend? Stock dividend, a 10% stock dividend, let us say. Okay. If you have 1,000 shares, okay, after the stock dividend, you will have 1,100 shares. Okay. The entry is going to be debiting retained earnings, okay, and crediting common stock. In other words, that's what is going to happen. From one equity amount, the amount will be deducted from here, retained earnings, and going to common stock. It will be at par value or at the market price, depending whether the stock dividend is large or small. That you study in part 1. Okay? That you don't have to worry. But all what you have to need to know for EPS calculation is there is an addition of shares without change in total amounts. Okay, now see this also, retained earnings. I'll show you the stock dividend, okay? If it's a 10% stock dividend, Okay, like let us say you had common stock, 1,000 at $10, let us say. Okay, so that is 10,000. Sorry, 10,000. Okay, $10,000. Fine. Let us say it is a 30% stock dividend. 30% stock dividend. So what will be the entry? It's going to be debit retained earnings by 3,000 and crediting common stock 3,000. Okay, so if you had a retained earnings balance, suppose you had retained earnings balance before the stock dividend. Before the stock dividend, you had a retained earnings balance of, let us say, 10,000. So your total equity would be how much? 20,000, right? After the stock dividend, the retained earnings is debited. Retained earnings has a credit balance. When it's debited, it gets reduced. Okay, so how much will be the retained earnings? Can anybody tell me? After the stock dividend, how much?
7,000, sir. 7,000.
7,000. And the common stock
13,000.
will be 13,000. The total equity does not change. It's just a movement from retained earnings to common stock. There is no addition of money to the company. Okay? There is no addition to of money to the company. Got it? In the case of calculation of EPS, suppose there is Jan, you started with 100. Okay, there's December. And yes, so there is $1,000 net income. Okay, net income $1,000. On 1st of July, there was a stock split. 2-for-1 stock split. Okay, 2-for-1 stock split. That means another 100 shares will get added on 1st of July. Do you agree with me? 2-for-1 stock split means the shares double, is it not? So another 100 shares will get added on 1st of July. But you will not take average like this. 100 divided into 6 divided by 12, you will not do. Okay. You will treat the whole thing as if it was added from the very beginning. Because there was no addition of value. There was no addition of amount to the equity. It did not bring any funds. It is just that these shares have been split into two. That's all. Okay, you take the average. Now see, in a bank, they take the average balance when you put in some money, is it not? Right. If you don't put any money, then there is no average. They will not calculate the average at all. Okay. Suppose that you had 100 rupees in the bank. Okay, 100 rupees in the bank you had $100. Okay, just a minute. There is too many WhatsApp coming. I'll just mute my WhatsApp. Okay, I'll give you an example. Suppose you had $100 in the bank in the beginning. And on 1st of July, you made that $100 into two $50 notes. $250. Okay, that 100 $100 here, what happens is it splits into $250. So will the bank give you for what will the bank calculate the interest on? They'll calculate on that 100 because there's nothing else coming in, is it not? Right. There's no extra amount coming in. They'll give you the interest on that $100 only. They'll give it to you from right from the beginning. Okay, like as if you are kept right from the beginning. Just because on July 1st, it became two $50 notes, they are not going to take any average here, right? They are going to give it to you. If you had brought in another $50 notes, here extra $50 notes, if you had bought it, then they would have given you. Okay, then they would have given you for $200, 100 from the very beginning. The other 100, they would have given it to you for half a month, half a year. But here, if the same 100 is splitting into $250 on 1st of July, they're going to give you interest on that $100 right from the beginning of Jan, right? So similarly, for stock split and for stock dividend, you do not take average because no money is coming in. Is that clear? Okay. So now what will be the, this is not dollars, this is shares. Okay. This is not dollars, this is shares. Okay. So the EPS is going to be 1,000, even though the split happened here. Okay. And it became 100 more shares was added. We will take as if it was done right from the beginning because there was no resources coming in. So it will be 100 divided by 200. Your EPS is going to be $5. Is that clear? Your EPS is going to be $5. For stock split, you do not take any average because no resources are coming in. And same with stock dividend. The equity amount remains the same. When there's a change in equity amount, that change has to be taken into account by taking average. If the shares bring in money, only then average is taken. Otherwise, it's just taken as if 100 shares is added right from the beginning. So if it brings in amount, if the share brings in some dollar amounts, then you take the average. Otherwise, you don't take the average. It's just like the same shares have been split. Like $100 has become $250. The amount is the same. So why should you take the average? Nothing new has come in. You understood? Yeah, what is the reason? See, I had shares of ICICI way back in the 90s. Okay. I had how many? I had 10 shares. Okay. It was quoting that time rupees 1,200 per share. So what is my total wealth? 12,000 rupees. Is it not? Am I right?
Yes, sir. 12,000.
12,000 rupees. They announced a 10-for-1 stock split. 10-for-1 stock split. That means for each share I have, for each one share I have, I'll get 10 shares. That time there was no demat. So I had to send this old share paper form to the company by courier. And they multiplied it by 10 and gave me 100 crisp new share certificates. Okay, I got 100 shares. I thought I'll be a rich man because 100 into 1,200, I thought I will be making, okay, that I will get now 120,000 my market value will be. No, unfortunately, the market price also reduced to 1/10. It hovered around 121, 120 like that. Okay. So now what is my total wealth again?
Same.
Same. It did not change to my disappointment. I was a young guy. I thought I'm getting 100 shares for 10 shares. Maybe I can sell it for 1,200 and get money. No. It reduced. Why do company does this? Because the shares are too expensive. Okay. It's too expensive to be traded by a normal person. Okay. Everybody cannot trade it. It's like you're having a 2,000 rupee note. It's as if you don't have money, is it not? You cannot buy idli. You cannot buy anything. Okay. Once I remember I had 2,000 rupee note when it was in vogue that time. When this government brought it in, then removed it and they made a mess out of it. Okay. So when it first came, I had a 2,000 rupee note. I wanted to have breakfast. Nowhere they have change. I went hungry. It's as if you don't have money. Okay. Like that, if the share is too largely denominated, in the sense the market price is too high, trading becomes less because people cannot afford it. To make the trading more, okay, to make the volume of trading more, so they split it, they bring down, automatically the supply is more, the value goes down, and it is tradable. Okay, that is one reason. The other reason is if they are afraid of a hostile takeover, they split the shares so that the shares are in more, it gets traded and it's with more number of people. Okay, the number of shareholders also increase. Not only the number of shares, the number of shareholders also increase because trading will take place and the shares will be with more number of people. Takeover becomes that much more difficult. A hostile takeover. Hostile takeover is one buyer will try to buy all the shares of the company to try and get control. Okay, that's why the promoters of the company keep a good amount of shares with themselves so that, it cannot be purchased by some big rich guy. You understand? So, one is to make it easily tradable. Another one is to avoid takeovers and to make takeovers more difficult. That is why a stock split is done. Otherwise, it really doesn't bring any real advantage to the shareholder. Like I told you, it's like you had one sandwich. They split it into two. I got the psychological advantage. You know what? I thought, oh, the company is giving me 100 shares. And that too, this 10 shares, those days I told you, it was not dematted. It was all in paper form. Okay. I had 10 old shares because as they are traded, the shares are, going through many hands. There are so many seals, there are so many stapling, everything. It was very old shares. In return, I got 100 new shares, crisp as ever. Okay. So it sort of made me feel good that I have more number of shares, but in reality, I have no extra wealth. Okay, so for the common shareholder, for the shareholder, a stock split really doesn't bring him any extra benefit. But it brings the company as a whole benefit. Okay, in the sense that it is easily tradable. They can raise finance easily because now the par value also has gone down. The market value also has gone down. They can get finance easily from many shareholders because they can afford it at that lesser price. Okay, and takeover becomes that much more difficult. It is the same with stock dividend. Okay, stock dividend also, just the number of shares increases, the amounts don't change. Okay, right. Okay.